Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And today we've got a look at Uniti Group Incorporated's latest announcement. And let's just say it involves a lot of notes, not the musical kind. But the financial can get ready for some interesting financing news. Before we dive in, if you enjoy getting straight to the point insights from company reports, make sure you are subscribed and swing by our Discord community linked in the description below for more discussions. Alright, let's get straight to the heart of this report. Uniti Group Incorporated, which we'll call Uniti for short, has just announced a pretty big financing deal. They're pricing nearly $1 billion in what they call secured fiber network revenue term notes. Think of these as loans backed by specific parts of their business. In this case, their residential fiber network assets, which are spread across Arkansas, Georgia, Kentucky, Ohio, and Texas. So we're talking about a massive amount of money here, $960.1 million. This isn't just one big loan, it is broken down into different classes with different interest rates. We've got Series 2026-1, Class A -2 notes at about 5.2%, Class B notes at roughly 5.6%, and then the Class C notes jump up to a much higher interest rate of about 7.7%. Generally, the higher the interest rate, the riskier that debt is considered. These notes are expected to be paid back around February of 2031. That is quite a long time, giving Uniti and its subsidiary Kinetic Abs Issuer, LLC, a good runway to manage these obligations. It is important to understand what is backing these loans. Uniti is putting up its fiber network assets and the customer contracts associated with them in several states as collateral. This means if Uniti can't pay back these notes, the lenders have a claim on those specific assets. The actual deal is expected to be finalized on the 30th of January 2026. Beyond the main notes, they're also setting up a $150 million variable funding note facility. This sounds like a line of credit that can be drawn upon, but it comes with strings attached, like meeting certain leverage tests and other conditions. It is basically a cushion for unexpected needs, but it is not guaranteed cash. Then there is another facility, a liquidity funding note facility. This one is even more restricted, specifically designed to provide just enough cash to cover the transaction's reserve needs and any gaps in payments. It is a pure safety net, not for general business operations. Now, who are they selling these notes to? They're not offering them to just anyone. This is being done through Rule 144A, which means they're selling them to what are called qualified institutional buyers. Think big investment firms, pension funds, and other large financial players who understand the risks involved. And it is also being done outside the United States under Regulation S. This tells us it is a private placement, not a public offering to everyday investors. Now, as is standard practice, the report includes forward-looking statements. These are essentially educated guesses about the future based on current information and assumptions. Uniti is saying things like they anticipate and expect certain outcomes related to this offering. However, they are also very clear that these statements are not guarantees. They warn that actual results could be very different due to a host of risks. Specifically, they're talking about this note offering and how they plan to use the money. They even list out the kinds of words that signal these are forward-looking statements. This is where they try to cover themselves legally, stating that anything that sounds like a prediction about the future is just that. A prediction, not a promise. And they hammer home the point that what they hope for and what they plan for might not actually happen. They're essentially telling investors, do not put all your trust in these future projections. Then comes the laundry list of risks. This is where they try to warn investors about all the things that could go wrong. They mention demand for their fiber services, market conditions, their ability to grow, difficulties from past mergers, competition, their own debt levels which could limit their flexibility, fast-changing technology, its system failures, data breaches, regulatory hurdles from the FCC and state commissions, legal issues, general economic conditions, and basically anything else they can think of that might impact their business. They are essentially saying, we could face a lot of trouble. They've also attached the press release they issued on the 15th of January as an exhibit, which is basically the source material for all this information. So what does all this mean? Uniti is raising a significant amount of capital by taking on more debt secured by its fiber network. This is a common strategy for infrastructure companies. They need money to grow, to maintain their networks, and perhaps to refinance existing debt. The fact that they're issuing these notes to sophisticated investors suggests they believe this is a viable way to get the funding they need. However, the higher interest rate on the Class C notes does signal a greater perceived risk for that portion of the debt. This could be due to the specific assets backing it. or perhaps the overall financial health of the subsidiary issuing the notes. It is a bit like a credit card with a higher APR for a larger balance. There is more risk involved. The sheer volume of risks they list is also worth noting. While every company lists risks, Uniti's list is quite extensive, covering market, operational, technological, and regulatory challenges. This means investors need to do their homework and understand that the path ahead for Uni might not be smooth. They're signaling that there are many potential potholes on the road to their projected 2031 repayment date. Ultimately, this filing is about Uni securing the funds it needs to operate and grow its fiber network business. The devil is in the details of how they manage this debt, navigate the competitive landscape, and overcome the numerous risks they've openly acknowledged. It is a strategic move to fuel expansion, but it comes with considerable financial commitments and inherent uncertainties. Alright, that is our breakdown of Uniti Group Incorporated's latest financing announcement. What is your take on this debt financing strategy? Does it signal strength or something else to you? Drop your thoughts in the comments below. If you found this deep dive valuable, hitting that like button really helps us out, and subscribe for more straight talking corporate analysis. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, see you next time.